and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our guests on the show. Joining us today are Vivek Mavani, who is an independent investment advisor, Nirali Shah of Samco Securities, she'll be here in a while, and Kalra of Target Investing. Today on Hot Money, we'll talk about Indusind Bank and Bharat Financial and the outlook of the merged entity. We also know that on 4th it's the date of the merger, so what will happen there? We talk about the consumer durable space and whether the valuations are sustainable. Counters like a Havells or a Whirlpool are trading at record valuations. Will they sustain, or will these valuations will actually have to come down? We talk about the auto sales numbers, which are a big disappointment yet again. And lastly, Zee Entertainment. What to do? There's no clarity on the proposed stake sale. So what should one do? The annual report does indicate that there is pressure there. There were related party transactions. But what's the verdict ahead on Zee? So that's something that we will discuss. Let's start with the first stock, and that is Indusind Bank. Now remember, on 4th of July, what will happen is that the counter will merge with Bharat Financial, and post that we'll have a merged entity. Ahead of that, Indusind Bank seems to be doing well. What's the way ahead for Indusind Bank? Let's ask our guest. Vivek, the counter has been facing a lot of headwinds because of IL&FS. Now, it's been rallying for the past few days given the fact that this merger will be effective. What's your view on Indusind Bank? Is there more pain, or should one start nibbling into the counter?
Well, I think there's going to be a lot more pain before it bottoms out financially and operationally. But before that, I mean, two positives about Indusind. One is this merger with Bharat Financial is both going to be EPS accretive as well as book value accretive. So that's one positive. At least it doesn't dilute the business. It doesn't dilute the balance sheet disproportionately. Number two, the promoters have announced a preferential offer or a preferential issue whereby they are going to be infusing about 2,200 crores maybe in the next couple of months. I mean, subject to obviously the regulatory approvals and so on, and shareholders approvals and so on and so forth. But it's going to happen maybe in the next 1 or 2 quarters certainly. So these are the two positives. But the negatives would far outweigh these positives, which would probably play out in the next 2-3 quarters. Number one, like you mentioned in your opening remarks, IL&FS, but although they have recognized 3,000 crores of IL&FS exposure as NPA, on their total gross NPA, which is a little more than 2%, 2.1 something, the provision coverage ratio is just about 50%. So from the existing NPAs, which they've already recognized, there still is a lot more provisioning that is required, which could happen in the first quarter and second quarter, maybe spread out. Now, the few large problematic corporates, DHFL, Reliance Capital, a couple of other real estate names, etc., have all happened in the first quarter, that is April onwards. So obviously there's going to be further recognition of NPAs and provisioning on that as well. Moreover, in terms of, if we look at the composition of their loan book, about 16% of the loan book is into the 4 stressed sectors, which is NBFCs, real estate, construction and infrastructure. If we add the traditional sectors which have given lots of pain and NPAs to the banking system, which is textiles, power and metals, then it's like almost 25% of the book is over there. I'm not saying all of that book is bad, but it is prone to slippages, and I'm saying even if the 10% or 15% of that 25% were to slip, we are at risk in terms of Indusind gross NPAs hitting something like 5% through the course of this year. Depends upon when they recognize and to what extent they recognize. Now, when we are into a 5% or 6% gross NPA potential, I'm saying in case there are large slippages, would mean provisioning requirement of something like 10 to 12,000 crores. Now, just to put that 12,000 crores in perspective, the March 19 net worth or the book value was 26,000 crores. So now we know which is what I was arriving at. The magnitude of provisioning requirements are still larger, and lot more pain could potentially come. I hope it doesn't, but that's the risk one does face. So my sense is, notwithstanding the rally that we have seen in the last few weeks, I would still avoid the stock till all this is out of the system.
Okay, Samir, does Bharat Financial bring anything new to Indusind Bank, or it's already priced in?
So I think as a sentiment, it's already priced in. As an operational level, I think it brings out a lot of new reach towards the deposit side as well as the loan side. How they explore it in next 1 year or 1.5 years is yet to be seen. The initial point is next couple of quarters the results will be combined, right, in a certain way. So how further cleaning up they do, because Indusind is still more conservative than maybe Bharat Financial management sees as of now. So I think on a merged book, how Bharat Financial book actually comes out and what kind of a stress you see in next 6 months. That's more important from my side as per the valuation. So I might see a further downside from here towards Indusind and wait for a couple of quarters and see the results and then take a call on the long term.
Okay, so that's the second view, which indicates that there could be some bit of concerns on Indusind Bank. Nirali, welcome to the show. What's your sense on this merged entity? What are you advising your clients to do on Indusind Bank?
So I feel that it is a marriage of convenience between Indusind and Bharat Financial, and the synergies will be extremely beneficial because for Indusind Bank, they will get a Bharat Financial 70 to 80% loan book, which is mainly focused towards rural areas. So because of that, Indusind Bank will be able to get focused in the rural area. There will be cross-functional synergies. Also, their NPAs will improve. Like this time, it's around 3.5 to 3.8%. And Mr. Sopti expects that with Bharat Financial's merger, it will become around over 4%. And the cost of funds are expected to reduce by 2 to 3%. Now we know that Indusind Bank has an exposure to IL&FS, but if you see, it is insignificant, like it is hardly 1.6%. So, and the cross stock has corrected by around 36% from its highs of 2040. So I feel that it is at reasonable levels now, and the merger will be beneficial for it to will be like a trigger point for it for a re-rating.
Okay, that's the view that's coming in on Indusind Bank. Two of our guests do believe that there could be more caution, but Nirali does believe that it's corrected significantly to play out all the negatives that have been priced in. The merger probably will be beneficial. So we'll watch out what happens on the 4th when the merged entity will start trading. The next sector we want to discuss is consumer durables. Now, day in, day out, you're seeing counters like a Havells or a Voltas or a Whirlpool do extremely well in trade, but valuations are way above their 10-year average, way above what the sector is doing. Is this a sector that deserves such valuation, or are we expected to see caution, or we expected to see more re-rating that will be coming in this sector? Samir, valuations fair, or you think they're overpriced now?
So I think see, the business is seasonal. That's why the valuations even come out much higher than what they are optically, because there are certain quarters where the depression really hits these numbers. So I think for that seasonality, first of all, the valuations are still very higher.
Okay.
Second of all, where people are anticipating that these higher temperature leads to higher sales. One fact is there that the dealer inventory is another issue at the consumer durables as well. So it's not only prone to autos, it's prone to even the dealership levels of these sales, consumer durables. So I think over there also there is a financing issue. There are certain issues over there as well. The pickup is slower than what it was last year. So I think it's more of an anticipation that the higher temperature will lead to higher sales this quarter, which I think will be only selected pockets. Maybe a Havells can show a Lloyd's consumer a better sales because they are still doing a network reach program going on. So that might help you the volume bump, but I think Voltas is running ahead of its time.
Any of the consumer durable names that you've recommended to your clients recently?
So we have a long-term holding in Whirlpool, and we have it at a very low levels from here. But we don't add on as of recent times. Of past couple of years, we haven't added any.
Okay, and Nirali, what's your sense on this sector? Do you think it's overvalued? Any of the stocks that you've recommended to your clients recently that you believe that could offer more potential upside?
So we would maintain caution on it as of now. because when looked at the ceramics or the white goods space, if you look at the PE band, so the low has been in mid-20s and higher has been 50s to 60s. Whereas now Whirlpool and TTK Prestige and the likes are actually in the mean. So they are mean in the PE band, they land at the medium. So that's why we feel that stock market is like a pendulum. So you should buy at the bottom. So we feel that there is still scope for it to correct some more. Also looking at the larger picture, the liquidity crisis that is going on, and there have been contractions at the grassroots level. So looking at that, we feel that even the consumer sales, durable sales are going to be affected, and maybe in 2-3 months they will be at a good price for investors.
Which are the stocks that you believe that one should accumulate on declines among the consumer durable space?
As he said, we are also bullish on Whirlpool and TTK Prestige.
Okay, that's the view that's coming in. Vivek, what's your sense on this space?
Well, a couple of points in terms of valuations. Yes, they have been at much higher than 10-year average, 5-year average, or whatever time periods one takes. But a couple of things that I would like to add. Amidst the whole market, I'm referring to broad markets, not necessarily the Sensex and Nifty stocks. While there have been concerns on growth, there have been concerns related to balance sheets, there have been concerns related to corporate governance issues, conflict of interest, promoters issues, stock pledges, leverage of promoters, so on and so forth. This is one pocket. Whether it's a Havells, whether it's a Whirlpool, whether it's a Titan, or TTK Prestige, you don't have any of these issues that plague the broad markets from the mid-cap space. Most companies are of much superior quality. They have delivered consistently quarter after quarter, year after year in terms of growth rates, number one. Number two, all of them have very healthy balance sheets with return on capital, return on equity, even adjusted for cyclicality, adjusted for seasonality. They still, all of them have upwards of 18% return on capital, return on equity. Most of them are debt free, or the debt is largely working capital debt, which is manageable. So you don't really have concerns on balance sheet side of it. And what we have seen in the last 1 year, as far as the market is concerned, a clear polarization towards good quality stocks and not so good quality or the bad quality stocks from the concerns and the outlook point of view. And fortunately, most stocks within consumer durables are in the good category. So as a result, in this polarization in the market, where as far as the bad stocks are concerned, every small rally is just getting sold into, and they keep making lower lows or new lows month after month. But as far as the good quality is concerned, month after month they make new highs, because every small correction there is fresh round of buying that keeps emerging for the reasons as I mentioned, because of superior financial performance. So notwithstanding the valuation, so long as the growth continues, I think these high valuations will also continue. So we can keep arguing and debating that, oh, the valuations are at much higher than the average, and they're at the upper band of so on and so forth. But fact of the matter is, for years, all of these high valuations have sustained simply because they continue to deliver quarter after quarter and year after year, and really no long-term concerns either on growth or related to promoters or governance issues in most of these stocks. I could also add Blue Star in this. I could also add Titan to this pack if permitted.
Okay. That's the view that's coming in on the consumer durable space. The other one is the auto space, which is bleeding now. We saw the numbers that came out for the month of June, and all of them disappointed except for a Bajaj, which probably came out with numbers in line. All the others did manage to disappoint as far as the number is concerned. So is this the worst over, or will things get even tough? Will this be a big problem even for the auto Inc. and auto other related components of the auto industry? Let's ask, I guess, Nirali, I'll start with you. We saw the auto numbers that came out. Right. You think that the worst is getting over, or will this problem even go in further, and for the next few months again we will see more disappointing numbers?
So I'm of the opinion that the auto numbers are going to see muted growth still till maybe February 2020. And so as you see the auto numbers in June, there was like a 14 to 15% decline in passenger vehicles, 70 to 18 in tractors. And if you look at the leader, Maruti itself had a 14% degrowth. Now when you see in January, February, March, it was a single digit decline, whereas it accentuated in May, June, April, May, June, and it became double digit. And even when all this was going on, the stock price was hovering at the levels of around 6,500. So we feel that it has not been discounted in the stock price yet, and Maruti and all the others are at the cliff. So if at the current budget there is nothing supportive for revival of growth, or there are no GST reductions, then the lubrication needed at the ground level will not happen, and there will be still further declines.
Okay, so you believe that the pain will continue. Which
Yes.
will you spoke about Maruti? Is that will that be the worst affected among the lot?
Yes, we feel that would be the way.
And anything in the auto space that you're recommending your clients to accumulate?
Not as of now.
Not as of now. Vivek, anything that you've told your clients to accumulate in the auto space?
Well, I have preference for the two-wheeler stocks, basically Bajaj Auto, Hero and Maruti in the passenger car segment, or rather four-wheelers. Now, I am a slight contrarian in this. The bad news as far as the volumes are concerned have been going on for 9 months. So there's June quarter end was actually the third successive quarter where month after month the volume declines, first a slowdown, then to single digit declines, and now to double digit declines. I think has been going on now for almost 9 months. But what we see on the stock prices, they have stopped falling. So Maruti, for example, since Nirali mentioned, after the fall from 10,000 to 6,500 has stopped falling. Bajaj Auto or Hero, for example, they continue to be in a 10% band. A Hero between 2,500, 2,800, Bajaj Auto between 2,700 and 3,000. That's the band that they've been trading at in the last 2 years. So it's plus or minus for like 5% on either side, 10% band that they have been trading at, notwithstanding the negative news flow that is coming on the volume side, pressure on margins, and so on and so forth. So from the valuation point of view, I think they are attractive. The market seems to have discounted the negative news flow, according to me. Not that the outlook turns bright anytime soon. Certainly not in the next 1 or 2 quarters. Maybe slightly longer term. One really doesn't have a choice but to be positive on the auto. For any economy, growth in the economy without growth in the auto sector is like difficult to fathom. So my sense is, stock prices have bottomed out. Stock prices are discounting the period beyond this slowdown and probably looking at next leg of growth a few quarters down the line. I think the collateral damage on the stock price is done with. I don't see too much of a downside. They can be accumulated from a 3 to 4 year perspective, not necessarily 1 year perspective, but 2 to 4 year perspective. I think there's not much of downside in these stocks.
Okay, that's the view that's coming in, and see, we're running out of time, so quickly we'll slip in the fourth one also, and that is the entertainment. It's been all over the place. Yesterday was up almost 5% in trade. I don't know what it's doing today, but that's the stock that we want to talk about. Basically, all the news is out in the open. The basic question is, should you trust the management? They are saying that the stake sale will happen. They've told the mutual funds not to sell. Basically, the fundamentals apart, it's now a simple matter of trust. Vivek, should you trust the management? Should you trust the stock or no?
Well, it's difficult to trust now because I would have trusted them any time in the past when the commitment given by Subhash Chandra to set right everything that went wrong. But seeing the latest balance sheet, what one realizes that there was a lot more hidden, lot more disclosures not made related to relating to the related party exposures, group company exposures, advances given for various things, including acquisition of film libraries, etc. Now, those things were not in the public domain earlier, so one would have expected that as well. Now, stake sale, I'm not doubting even 1% that the stake sale, the management is not serious, the promoters are any less serious. What the promoters have lost out now is that their negotiating ability from a position of strength is now to position of weakness, because the potential buyers are limited. The potential buyers also know what is happening and what is the state of the promoters. So obviously the premium that one would have expected 6 months ago, that premium probably has just vanished, and and as the deadline nears, the promoters would probably have to accept whatever valuation is on the table and not be able to drive it upwards.
Okay.
Now, as the deadline nears, if the stake sale doesn't happen, I'm sure the lenders are going to start dumping the stock against which the loans have been taken, or the personal leverage has been taken. So that risk continues to remain in terms of what happens first. So even if stake sale happens first, it's not going to be at any meaningful premium anymore. So my sense is one should just avoid the stock.
What's your sense,
So I think exit on any kind of bounce, because even
Similar
promoters
strategy,
are exiting.
Okay, you don't trust that anything probably will happen.
Even if it happens, let it happen, then you can recalculate, because the industry is facing a regulation change as well. So that will hit the revenues and the advertising revenues, and which is already happening now in quarterlies. So I think stay away from the industry as well.
Is that something that you agree with, Nirali?
I agree with both of them, and I feel that the investors should not get in at the offer price as well, and maybe wait and get a sense of who the buyers are and how it will help the stock, and then maybe get into it.
Okay, so I think the consensus view that's coming in on Zee Entertainment is that wait and watch till the time there's no corporate action that happens, or a corporate development wherein the company is sold to another party. It's difficult to gauge what probably will happen on the stock. But with that, it's a wrap on today's edition of Hot Money. Let me thank all my guests who came in today. Vivek, thanks so much.
Thank you.
Nirali, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Queen.